Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Peterson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Peterson. So today I have with me Heather Dreves with Accredited Investment Corp in Boise, Idaho. How are you doing today, Heather?
I'm doing great, but we are actually out of Coeur d'Alene, Idaho.
Oh, you're right. You're out of Coeur d'Alene.
We're way north.
You're way north. Yeah. Well, man, yeah, you guys are we're in the midst of a heat wave. And so we were 116 today in Portland. They're going to hit 108 today,
it is hot.
Crazy. Yeah, that's right. I forgot you guys are up in Coeur d'Alene, which is God's country, by the way, for those who have not visited Coeur d'Alene. It is absolutely amazing.
Yeah, we just had the Ironman race here last weekend that literally ran in front of our office. They shut down the whole downtown Coeur d'Alene area because the bike route and the running route actually go right in front of our office. So it's a pretty neat little town. Not little anymore, though.
No, I've heard that everyone with the pandemic sort of decided that, hey, we should all move up there.
Yes.
which is a good idea, but I mean the housing prices were already pretty steep in that area, and now I'm sure it's just completely out of control. And speaking of Boise, I think Boise's the same. So Idaho is no longer a hidden gem that people have never heard of. It's the secret's out. Everyone's aware that it's a great place to live.
Yeah. Well, we tell people when people ask about it, we say it's terrible. You would never want to move here. But like you said, the secret's out, so that doesn't really work anymore.
Exactly. Yeah, that's just kind of what we say about in Portland here too. But yeah, I think all these great spots, especially in the Mountain West, I think people are onto them. So we'll see a lot more migration there. But why don't you share a little bit with us how you kind of got into the business? I know you guys are private lenders. You've been in business a long time. But maybe just share with us, like, how did you get into this? Like, how did you get involved?
Well, that's actually funny because it was completely on a whim. I stayed home with our two boys until they were in elementary school full time. I actually had a very good friend that worked in the private money industry and had inquired with him about what he was doing. So actually went on board with that company. And kind of started from the ground up. I mean, I literally started as a loan officer's assistant. He was probably, and to still this day, the most successful private money loan officer I've ever experienced and got the pleasure of working with. Learned how to manage escrow accounts, service accounts, obtained my securities license because I started dealing with our clients that bought our trust deeds from us. Mm-hmm. And so just really evolved. And honestly, looking back, I'm so thankful I started from the ground up because I have such a better understanding of everything that goes into it. And I don't think that people realize, all the nuances and the back end that goes into originating, managing private money notes and funds and things of that nature. So really just over 15 years ago, started in the private money industry.
Yeah, no, I agree with you. That's sort of how I got into, is from the lending side, not as ground level, but definitely, when you're looking at things from the lender's perspective, you really appreciate everything that kind of goes into it to ensure that that you sort of got a perfected interest in the collateral and title insurance, everything that's involved, to ensure that everything goes right, and all of the underwriting, and just a lot of boxes to check, a lot of things you have to do. Yep. Insurance, another big one that people don't think about. Like, well, of course, people have got insurance in their house, but as a lender, it's not your house. How do you know, right? Like, it's right. The big one I think people overlook. It's just you've got to monitor and make sure that there's coverage in place, and you have forced place insurance if it wasn't. And,
mm-hmm.
Those sorts of things are little gotchas, and because you do hear from time to time, people who do think it's easy, like, oh, I kind of made some money doing something else, and I'm going to start doing some private lending. And It's kind of like, well, I mean, not to say you couldn't. It's not rocket science, but there's, you could really get into, some trouble if you don't really know what you're doing. And I think many people have, and they realize, like, the pros the pros have got a process, they got people, so those are some of the things we'll talk about today. But so for you guys then too, I know that really the business at Secured Investment Corp is expanded as well. I mean, for being in what was a small town, the tiny town of Coeur d'Alene, which as we said, is sort of growing, but your reach is much further. So maybe share with us a little bit about, how you guys go about originating. I know you've got at your direction, I think, in large part, a huge marketing initiative on the acquisition side to get the word out to borrowers. But maybe just share with us sort of what that looks like and what you guys are looking for, and really how far the reach is with it.
Yeah, absolutely. Well, and I think it's important to kind of back it up a little bit as far as how we started as a company, because I think that explains how we evolved into being a private money lender and an originator and a fund manager. We really cut our teeth on the real estate education space. And so we educate individuals that are looking to get more involved in real estate investing, whether that's through a fix and flip strategy, a buy and hold strategy, and we even have programs that educate people on how to be brokers and be a middleman and really, broker deals out to private lenders to help take care of their clients' funding needs. And the reason I think that's important to explain is that's where a lot of our deal flow comes from, because as an originator and a fund manager, the biggest concern you usually have is, do I have enough deal flow to deploy the capital? And, we really believe here at Secured Investment Corp of having this organic environment. So we essentially eat what we kill. I mean, we create a lot of lead flow, not only through our education, but our marketing team that we have. We have a high presence on the internet, social media, things of that nature. Marketing to people that are looking for funding for their real estate projects. And then we have this huge origination team that we've put together, right? We've got loan analysts that literally just sit on the phone all day and go over deals with people that are looking to structure deals, really making sure that they fit our credit box. We are a private lender and we are outside of more traditional ways, but we also have a very clearly defined credit box. And so these loan analysts vet the deals. If they're a viable deal, then the deal moves on to a team, which is our loan officers, and a processing team, and they take the deal from there. As you mentioned, there's a lot of due diligence that goes into these deals. We order appraisals, we order title insurance. We want to make sure that we have a first lien position on these loans that we're originating. We want to order an appraisal, make sure that the value's there. There is just a huge team behind this whole process. And then once it's originated, we service all the notes. So we have a pulse on what's going on with these notes, and that's important because when we originate these notes, they're originated on our funds. That's how we create earnings for our fund members. So it's really important for us to make sure those notes are making payments. That's how we all make money. And so, it starts from the guy that just comes in, has a deal, we vet it, we underwrite it, originate it, service it, we see it all the way through the end. So we have about 100 employees here internally that keep all those wheels going. There's a lot of working parts.
There is. But I like when people have, built sort of these like truly vertically integrated businesses, right? And I think, even for us in my day job at Verivest, when, not doing the podcast, I mean, we try to do the same thing. Like, how far upstream can we reach, right, to meet our end user client, right? In our case, it's deal sponsors like yourselves, those who are looking to raise, money for their deal flow, to fund their deal flow. But really it is. It's like, how can you meet them and be strategic? And I think that the education component, it's a lot of stuff too that I tell people when you're trying to raise money. The same thing with investors. You got to reach upstream, and it's usually educate, right? Like awareness and education and helping them solve kind of root level problems allows you to develop relationships with them in a different way, because at the end of the day, you guys at Secured Investment Corp and Lee and the whole team, like money's fungible. So, it's every dollar's the same. And so ultimately it comes down to, what am I going to pay for that money? What's the interest rate? And so if you're trying to compete on that basis alone, it's going to be difficult to originate. It's kind of the race to the bottom. And every time the money's got to be cheaper to get the loan or put the money out, your risk goes up, right? Because it's not being compensated. Right. So I think models like that, and when I'm talking with investors too, it's like look for. There's got to be something more to it than just whatever they're doing. I mean, you fix and flip houses, or you make loans, or you buy apartment buildings, or whatever. It's like, but how do they go about sourcing these opportunities? And you got to look at the total. These are businesses,
Right.
so how does the business work? Is a big part of it. So for you guys though, like on the education side, how do you do that? Is it like through online classes, or do you do a lot of like boot camps and that kind of stuff? Maybe share a little bit with like what that actually looks like on the education side.
Sure. Well, I think COVID
Yeah.
changed all of that, to be perfectly transparent with you. I mean, before COVID occurred, we would put on average 4 events a month, and they were all over the United States. They were anywhere from 3-day to 4-day events. Once COVID hit, honestly, it was a really good thing for our company and our clients, because we reassessed things and we said, okay, we can't physically go to all these different states and put these events on. So we started putting on events through Zoom calls and live events. And now we put on, I'd say on average, 6 to 8 a month. We do our high-level training at our corporate office in Coeur d'Alene, Idaho. We probably put a couple of those on a month. We have one coming up next week. But it has broadened our reach, right? Instead of being able to reach 60 people at one event once a week, we will have over 150 people on those live events 2 to 3 times a week. And like I said, those events are really important for us because it's also creating really good deal flow for our origination side of our company. They're more educated borrowers, they're more educated brokers that understand what our guidelines are and what our credit box are, and that is creating deal flow ultimately for Kogo Capital, which is our origination side.
Yeah, so the
of our
Kogo
company.
Capital side, because you and correct me if I'm wrong, but didn't you guys? Isn't that sort of had like a franchise model too, or is that like that broker side where you train them to be the brokers who are then out there, kind of distributing or pushing the Kogo Capital product?
Right. Yeah, it's not technically a franchise, but we do encourage the brokered side of the business model. We don't require people to technically be certified brokers that came through our program, but a majority of them are. We will work with other brokers, but typically, that broker deal flow is coming from our education. And it's probably, I'd say 80% of the deals we originate are brokered loans.
And then, in terms of like geographic reach, then I mean, is it all 50 states, or there's the
We are in about 48 states right now. There's a few of them that are still red for us. We're working on licensing in the rest of the states, but we're pretty much nationwide as far as our origination side of our company goes.
I mean, I've heard for people doing that it's more work than I think people realize too, right? Just with the lending laws, and so maybe explain just the compliance side of it, how onerous that's become in the last.
There's a lot of that. I mean, our compliance team deals with everything from the loan origination compliance component, which, like you said, is complicated. There's a lot of states you have to be licensed in. There are some states that don't require it because we are lending against non-owner occupied properties. So these are technically business loans. Our borrowers are all entities, LLCs, things of that nature, and these are for business purposes. But again, there are a handful of states that do require licensing. We're licensed in California, actually Oregon, where you're from. And then, not only on the origination side of it is there a lot of compliance, but on the fund management side of it. So, we have 2 different funds. One is a Regulation A+ fund, which is very regulated. So there's a lot of compliance with that. The other is a little less regulated because it is for accredited investors only. So we keep our compliance team very busy.
So with, like you talked about sort of the box, the underwriting box, what types of loans are you doing? Like, what are the terms, and what are the rates and the points, and what is sort of the criteria, as far as the loan, and maybe even speak a little bit too to like how the borrower, what kind of borrowers are you looking for, and
Sure. So our sweet spot is residential. What we focus on is any loan against a single family 1 to 4 unit. Again, non-owner occupied. We decided a long time ago, and this is one of the things that I appreciate about our founders, Lee Arnold, is we stay in our lane. Residential, fix and flip is our sweet spot. We do a lot of rehab lending. And terms is going to be, I'd say our average loan term is 12 months, but no more than 24 months. We do not charge prepayment penalties, so that's a big one out there. We encourage our borrowers to pay us off quick. It is, in some lenders' opinions, is they don't want to put their money out there for less than 3 or 6 months, but we encourage our borrowers to get in and out of their loans as quick as they can because they're making more money, and more often than not, they come back to borrow from us when they're successful. So, again, our loan term is 12 months. Our rates start at 8.99% and 1 origination point. And then we have a pricing matrix depending upon the borrower's credit, their verified experience, money down, things of that nature. I'd say our average loan probably prices out at 10 and 2. That's just on average. The lower end of it's going to be your very qualified borrowers with
so
very, very
what
good
kinds of
credit.
trends have you guys seen then? With so you said you used to do a lot of live events, lots of your deal flow kind of shifted that to more virtual and online. But have you seen like an uptick in activity? Like, are you funding in terms of like your loan volumes and how much funding you've done? Is it going up? Is it going down?
It's definitely trending upwards. I will tell you, through COVID, and you guys probably experienced this, it was a very interesting time, right? We had deals where we were brokering them out to bigger money that was a little bit lower terms, or not terms, but rates, and they shut off overnight. It was Wall Street money, and literally these loans were ready to close, and they were done. And one of the things we've always agreed with as a team is we're always going to fund through our funds first and foremost, and then use other resources like that secondary. And I'm so glad we did that because we never stopped lending through COVID. And I think we're seeing a lot of repeat business because we were there when a lot of lenders weren't. There were lenders that shut down. I talked with colleagues of mine, they weren't lending for 6 months. I mean, they just stopped everything. We never stopped, and we definitely have seen an increase in volume because of that. I would say one of the trends we're starting to see is a lot of real estate investors are looking for long-term financing. And this is typically on properties that they're renting or holding as an Airbnb. And so you see a lot of, borrowers, real estate investors that are looking for something longer than 2 years. So we're exploring some options. We're getting ready to roll out a rental product that is a 10-year ARM based off of a 30-year amortized loan. So that'll be really big for us.
And that is, maybe we can touch on that too, is like you've mentioned it repeatedly, but what you do that's different than a lot of people is that a lot of people will use maybe some bank warehouse line to kind of hold their loans as they fund them, and then they'll sell them off or put them into a fund. Whereas you guys use the fund almost like a warehouse line. So, I'm not sure the last time I looked at the portfolio or whatever, but it was, the oldest loan in there is, they're all like they've recently funded. So, most of them are moving out.
Right.
They move out, which is kind of opposite or inverted from what most people do.
Well, and our model's interesting in the sense, too, that you're correct. We don't leverage our fund. We don't use any warehouse lines to originate our loans. We do that all through our funds that we manage.
Yeah.
But we also sell those trust deeds immediately. Most of our trust deeds will be spoken for the day that we close. And so you'll see that our loans that we originate typically will turn and sell off of our funds within a week's time. So the fund has the ability to recoup its capital. We keep an interest strip on those when we sell them, and then we go originate more. And I think that's something that's helped our funds balance and have really consistent returns. We also throw in real estate assets. So one of the things I haven't mentioned yet is we have a whole acquisition team. We have a team that goes out, finds real estate in our local market, Coeur d'Alene, Idaho, and Spokane, Washington, and we actually invest a portion of our funds in those real estate assets. So we have revenue coming from loans we're originating, but we also have revenue coming from these real estate assets too, and that really helps balance our portfolio.
And so
as
when
far
you
as
guys
returns go
acquire
also.
assets, so you're doing some sort of light renovation and then renting them?
So we have an acquisition team. We also are a licensed and bonded contractor. So we are a general contractor. The majority of what we buy, we buy with a strategy to fix and flip. So light rehab, go in, sell it quick. But honestly, lately, with everything going on, we've found a lot of opportunity in buying rentals. There's a lot of very distressed landlords out there that are looking to just offload these rentals because they have troubled renters in them. You know, we are a bigger fund than most mom and pop landlords, so there's been a lot of opportunity there too. So we've started buying a few, assets that we can hold as rental. Again, those are only single family 1 to 4 units, so we're not buying apartment complexes or anything of that nature. We're still staying in our lane.
Yeah, it makes
but
sense.
sprinkling some of
that's
those in
where, especially when you see this often, is that you see people who have the ability to do the work, sort of keeps you sharp. You call your borrowers are out there executing the same strategy in their markets. So, knowing what the cost of materials are and, keeping up on those sorts of things. I think sometimes it's another part of lending that people, it's things change and they're sort of out of practice a bit.
Yep.
And, that's where you can start to see some distress and loans kind of going sideways on you. But if you're sort of keeping your craft, you know what to look for. You know kind of what's going on, which is sort of a good segue, I think, into the other piece of your guys' business. I mean, you mentioned you have 100 employees, so it's like this. You kind of give you a scope. Probably one of the larger employers in Coeur d'Alene, certainly. The loan servicing side. Another one of those areas where sounds easy, you just collect payments or whatever. It's not. It's a complicated thing. So for you guys, maybe talk about that process of how you service your loans. And I think you often will service loans for, I know the loans you've originated, but even other people's loans that you've originated as well. So it's like a whole separate business, right?
Mm-hmm. Yes, it's a completely separate company. We used to outsource our servicing, and like a lot of things that we've brought internal, we've tried outsourcing it. At some point as a company, you try to determine is the return on investment there, or is it better off outsourcing it? We didn't have a great experience, and so we invested in the software systems we needed to service it. So we service about 500 loans right now. And yes, we do service, we will bring in outside loans for servicing. And they do everything from just the initial set up the loan. We do require our borrowers to make direct payments. We set them up on ACH, when we close the loan. But then on the lender side of it, when we sell those trust deeds, we have a lot of lenders that use IRA accounts, self-directed IRAs and 401ks. So depending upon how the lender purchases the trust deed and how they're vested on title, we'll set that up in servicing. Those monthly payments are dispersed to them or their custodians, depending upon how they funded the deal. We do all monthly collection efforts. We provide all of the end of the year tax information for those trust deeds that we're servicing. And then we even have higher level servicing, so we do have foreclosure management, and then also REO management. If the lender takes a property back through foreclosure, we'll go find them a real estate agent. And the kind of the neat thing that I like about what we do here is our reach is so broad. There's oftentimes been, hey, we got this property out of Missouri. We get in our database of students that have went through our program, and we've been able to call up someone and say, hey, we've got this property. One of our lenders wants to sell. Are you interested? So I just think being able to tap into that we have the ability to do is a huge benefit to lenders that are buying trust deeds, because we all know the risk. Yep. The risk buying trust deeds, you might have to foreclose. I mean, that is a very small percentage of our portfolio, but it happens. And so we like to be transparent about that. But we will help them all the way through the end. We're not here to just sell a trust deed and wish them luck along the way. We go to the end of the road. So, and then we also have draw management. So part of servicing is to manage our rehab projects. So when our borrowers need a draw to complete their rehab project, our draw management team coordinates an inspection, gets the inspection back, evaluates it, makes sure, things are done as they should
it's
be,
sort of
and
like
then they will
turnkey
release the draw
rentals, but
accordingly.
with loans. It's what you guys have built, and I think
Yes.
that's what makes it
A
a
lot.
unique platform. To have and obviously you guys have been at it quite a while, but you sort of have this robustness, and really, your origination platform is impressive. I've been in the business since 2008, and I've known, about you guys. It seems like the entire time I've been in business, at least Lee. And you really look at the Kogo Capital name, and obviously that was sort of the golden years there. It was in 2011, 2012, 2013, when there was all those distressed assets on the market. But, just seeing how that's been built up. It's definitely a machine that you have on the acquisition side. And then with the addition too of the loan servicing, which is most lenders, on the Veriva side, we've got a lot of, we administer a lot of debt funds and mortgage pool funds, and the servicing piece is the piece that just trips everybody up. It's tough. And so to sort of build that out and I think for you guys too, especially the fact that you're selling off a lot of the trust deeds to individual investors, ostensibly, you have to. That's a lot of moving parts. Because what's the average? The average loan is, what are they? They're like 200.
No, I would say our average loan size is probably 130,000, maybe 140. And usually with a loan that size, there's probably $50,000 in rehab. So, not only is it servicing the loan, then you've got your draw specialist making sure that they get the work done. We meet as a team. We meet on a biweekly basis just on servicing. Just to look at, okay, these are accounts that might be having some trouble. Our draw specialist joins us. She has a pulse on. If we see someone go 30 days and they haven't asked for a draw on their rehab, we're calling them. We'll force an inspection if need be. Because, the reality is you let them go 6 months and they haven't asked for a draw and their project is stalled, you're in big trouble. So the quicker that we can help them navigate through any hiccups that they might have, or challenges, the better off everybody is. The better off we are as a company, the better off our lender is that bought the trust deed. If they're not paying and getting the project done, it hurts the funds too. So we have a very good pulse on all those accounts and what they're going,
in terms
what's going
of,
on with those.
I forgot what I was going to ask. So the people that are buying the investors that are buying the loans from you. So do you see? Does a lot of those end up being like the students as well? Like, is it pretty? Are you sourcing this? It's all from kind of the same bucket, or do you find that they're more? I'm just curious. What are those? What's the profile of sort of someone who's buying the trust deeds?
I think in the past it wasn't the profile of our students. Our model and our motto here at the company is the circle of wealth. Our goal for all of our clients, whether they come through education or they are just an investor, a passive investor, we want everybody to become an accredited investor eventually. That's our goal for everyone. And I think, we've been around a while now, and we're starting to see people that came in through our education were very successful as investors, meaning they fixed and flipped, they brokered, they've created wealth, and now they're starting to come over to the passive side. We have a lot of the passive investors that also go into our funds and buy trustees. So they like to diversify their portfolios. I would say there's more crossover that way than necessarily from the student side of things. We've also tapped into some groups like dentists, that are looking to just actively invest or passively invest in real estate assets. And so that has kind of taken off for us. Verivest has been huge for us, the fact that you have this awesome platform out there where people can go to and find people in this industry that are good actors instead of bad actors, because there is a very negative connotation out there, and there's a lot of very bad actors managing funds. I love it. Getting involved with you guys has been one of the best things we did, and it's been a great selling tool for us. So, we're very appreciative.
Yeah, I mean, I think that's
of
the cool
finding
part
you
about it, right?
guys
It's just
being able to be part of this.
It's being able to, create greater awareness for those who do the right thing. I mean, who actually, the problem with the word like integrity that I find, right, is that it's all. It's like, yeah, I have a high integrity. And so everyone sort of says that. Well, the whole definition of integrity is sort of like, I do the right thing when no one's looking. Well, if no one's looking, then how do we know? So you don't know. And that's the issue.
Yeah.
And really, you have to spend a lot of time with someone to really be able to corroborate whether they have high integrity, they don't, which, in the world is flat. The world is now flat. So, you've got people all over the place who are looking for these types of investments. You can't build a personal relationship that's, 2-3 years and where you're seeing them once. I mean, like that doesn't exist anymore. So trying to help shortcut that for people and narrow down the scope of what they're looking at so that they can focus on figuring out what makes sense. Because like you said, hey, the fund, that might be, one piece of it. But if you do want to sort of go long and acquire certain trust deeds for, on properties in certain areas or whatever you have, I mean, you can do that. And so knowing, because really that's what it's all about is like, what's your portfolio look like? What does your portfolio need more of? I mean, maybe you want to kind of, diversify it that way. Just knowing who you can, go to figure out who solves that particular problem that my portfolio has. I mean, I bet a lot of people listening to this may, there's many people out there who don't even know that you could buy individual trust deeds like in your IRA, right? As an example. So
I know.
But it's hard to figure out like who offers that. I mean, if you know someone who's a private lender and you've done it, then you're sort of aware of it, but the vast majority of people don't. And I think you guys have made it a pretty seamless process because don't you have there's like a marketplace or like how do you let people know? You like send out an email with like here's the different trust deeds that are available to invest in or.
Yeah. We have a couple different marketing strategies. We send out a Thursday funding email. It goes out every Thursday morning, and we highlight four trust deeds that we have for sale. And that a lot of people love that. We also have on our website at Secured Investment Corp. We have a marketplace essentially. So you can go, all of our trust deeds are immediately put up there as soon as we close them and originate them. There's a lot of specific information to that specific deal that these people are looking at. But then above and beyond that, if they truly are interested in the trust deed, we will provide them with what we call a loan package, and we put together a file that is everything we use to underwrite. We provide them with all the borrower's information to include credit, bank statements. I mean, it's all secure and redacted. We provide them with all the information about the specific property, so appraisal. If there's rehab involved, we'll provide them with the contractor's bid, the preliminary title. So really, everything we use to do our due diligence to underwrite, we provide the lender. And then our lenders, do their due diligence, and then they make the decision if they want to move forward from there.
Like investment advisors, like wealth managers, who've had a hard time sort of finding the fixed income replacement, right? Like they used to use bonds and there's just different ways, but now with the volatility there and there's no yield, it's a big problem. And so, I'm getting more and more of these phone calls where they're like, well, we want to put together potentially a pooled vehicle where we can, I mean, they've sort of heard now about trust deeds. And so, the wheels are spinning and they're realizing, well, man, if I could go and buy, some trust deeds, I could create a little diversified pool of, and of course, for people like us, we've been in the business forever, but it's like, and they're like landing on like, that could be a thing. I'm like, yeah, people do that all the time. Exactly. But it really, so it's starting to see that more people are understanding how it fits in the bigger financial picture. Right. And I think you mentioned the dentists are a great example. I mean, they're looking for, they've made money and they're looking for ways to, how can they diversify their income? They're in people's mouths 4 days a week, and how do they create these other income streams, right, that are passive and in hopes that they can sort of transition out and sell their practice or whatever. But I mean, they want to live the life they want to live. They want income coming in, and trust deeds are a great, they're a great instrument to sort of to do that, especially the hands off. Because you think about it, rentals are. I mean, everyone's sort of like, yeah, I started in single family rentals, but rentals are a pain in the ass. I mean, like oh, they're total pain, right? So, but I mean, like a trust deed, especially if they've got someone like you guys who's basically handling, draw requests, and you can handle. And once again, God forbid something does go sideways, and the foreclosure. But just to know that someone is there to do it, because even if you do buy a trust deed from somebody, well, if they're not going to do that, that kind of stuff for you, especially if it's in some other state. I mean, that's terrifying. But that's really the value prop that you guys have that I think or makes you unique.
Yeah.
Truly unique.
Yeah, I agree. And I think that, if some people aren't as risk adverse and the trust deeds are scary to them, and like you said, we do just about everything for you other than decide which one you're going to fund. The funds that we manage are a perfect alternative because essentially it's the same asset. What makes the fund money and what secures the fund are those trust deeds. So, it's one or the other. Some people don't want to buy trust deeds because it's scary or they don't have enough money. We don't fractionalize our trust deeds, so they have to buy the whole trust deed. And some people have, $10,000 sitting in an IRA that they never did anything with. Well, the fund is a perfect alternative for that. You're still going to get the same kind of yields, but you have no management of it. You don't have me calling you saying, hey, Lance, your guy didn't pay. What do you want us to do? We'll foreclose. We'll do it for you, but you got to decide. And so I think we're able to just about offer everybody, everything that they're looking for if they really are truly looking for something that's backed by real estate.
That's why it's the fun too, especially with the way you guys have structured it. Super high velocity. Because some of the debt funds, like I said, it's more of that they are portfolioing the loans, so they intend to carry them to maturity or payoff. Which once again isn't a bad thing. It requires more capital. I mean, obviously, the amount of volume that runs through yours with what really isn't. I mean, it's a big. It's what $20 million, $25 million worth of capital, but there's a lot of loans that are cycling through there. But that's good because you've got this. It's high velocity. It's liquid, so you're not having stuff go stale. Not to mention that if the market did start to turn, the market, even when real estate market's turned, it happens more slowly. So your ability to sort of, for you guys to then begin to, react to that is much better. And, because ultimately the people that are buying the trust deeds are the ones who are holding them, individually in their own account. So there's a lot to like about it. And then not to mention that servicing spread too, because it's really risk free. I mean, I don't know, do you guys have is there any kind of clawback or where the fund is obligated for that, or the servicing strip is just purely it's
Yeah, it's purely just a interest spread, and if the loan were to stop paying, that end lender that bought the trust deed, they're responsible for foreclosure costs. Let's say they ultimately got it back through foreclosure and it's an REO, we would be out our interest spread, but we've already got our principal back. So it is very risk-free. And the fact that our notes are so short-term in nature, 12 months to 24 months, that's one of the things with markets shifting. Like you said, they typically shift slowly. It's not like it happens overnight. But we're not writing 5-10-year paper. These are short-term notes. We will never write long-term notes through our funds. And so that also gives us the ability to pivot and adjust as a fund management team and an originator. The other thing that I didn't mention that I think is important to bring up is we don't lend above the FHA cap, which means we are not lending on jumbo home loans, high-end, expensive homes, which are typically, when markets shift, those are the areas that are affected first. If we believe if you're under that FHA cap, there's room to pivot. As a borrower and a homeowner, if you're planning to rehab this project and sell it and the market shifts, you could potentially rent it and cash flow it if you're under that FHA cap. The rental market is becoming very fruitful. And so, as a team, we try to look at these things like things are ever changing. It's a moving target all the time. And, some of these things that we've put into place as far as guidelines, processes and procedures, the reason for that is so that, the funds are protected, our end lenders that buy trust deeds are protected, but we're also putting
that's
our
right. I mean,
borrowers
that's a
in
great
good
point
place
you
where
bring
they're
that
going
up,
to be
because
successful
it's
and they can
about
get out of these deals
those are your
and make some
exit
money.
strategies, right? So the exit strategy is a refinance out of the loan. It's short term. If you're above the FHA cap, those are the programs that, I mean, once again, I mean, who's the buyer? How do they refinance? If it's even the borrower, where are they going to get the loan from? And that's more challenging. So really, that's what I mean. It's all about this velocity or liquidity.
Yep.
Single family homes below the FHA cap, those balances, all of those, the fact that how you've structured it to, it originates transactions that puts you guys in position to act fast, makes you more a preferred borrowing source, or someone to borrow from, I guess a lender for the borrowers. And it's just those little things. And I think that when you get into this space and want to be a passive investor and you're looking at all these things, that's why I say you got to pan out and kind of look at their business and figure out like what's the method to their madness. It's not to say that like everyone should do it how you guys are doing it. And once again, it took you years to build up the business, you know what I mean, to be able to do all this stuff. That's what I tell people too all the time. But even at Verivest, I'm like,
a long time.
Man, it's been a slog. I mean, I know it's like we do lots of stuff, and it's but we started just with one part, right? And then you expand that and you expand this, but it's the same thing. You're trying to create the ultimate solution, or to get to a point where like you guys can say circle of wealth. The circle of wealth thing wouldn't have held, it wouldn't have held years ago, right? Because it was just the one piece of it. But now, I mean, we can just, last thing we'll touch on, there's so much we can touch on with you guys,
right.
But the Reg A Plus offer, was that designed so that you could allow some of these people who were non-accredited to get in as well, right? Was that the intent?
Absolutely. I mean, we've had our accredited investor fund for over 8 years. And honestly, we felt like we were doing a disservice to the people that weren't accredited, because you had this huge disconnect. You had accredited investors or people that had enough capital that could buy trust deeds. On average, a trust deed's $50,000. We'll go down to 30, but let's just say, I would say our average is about 50. And then we had this handful of students that were encouraging, hey, get involved, start investing, buy trust deeds, invest your IRA. And they're calling going, I've got $5,000 in an IRA. What am I going to do with that? Or I have $10,000 in a 401k from 5 employers ago. I never even moved it over. And we're thinking as a team, wow, we are really disconnected with this type of client that we're encouraging to be an accredited investor. How do they ever get there? And so, going through a Reg A offering is no easy task. It's expensive. It's daunting, the due diligence the SEC does. But we just felt really strong about it. And so we went through the process. We're one of only a few in the United States that's a real estate Reg A fund. And our minimum is $1,000. And what we do is we capture tons of people with self-directed small balance IRAs and 401ks. And that's, very popular right now. These IRA custodians put on tons of free webinars and education. So it's really gave us the ability to help our clients move those types of accounts, get them in a custodial account where they can actually do something with it. So that was the whole purpose of that. And, it's 10 times more work there in our accredited investor fund. It's more expensive, but it has helped us help our clients and other people achieve, their financial goals.
And that's sort of that
get
North
closer
Star,
to
right? So like
financial
for you
freedom
guys,
than
it
we were
is,
without it.
it's letting the mission sort of drive how the business evolves. And I would say that too. People ask like, well, how'd you guys get into this? And I'm like, well, back in December 2011, Matt and I were in a hotel room doing, we were up visiting our business coach to do our annual planning for 2012. And we said, what do we want to be when we grow up? Right? Like we want to pivot the business. And we said, we want to help worthy real estate entrepreneurs, gain access to capital, create a flood of capital to worthy real estate entrepreneurs. That was sort of like North Star. Whatever we do, it's going to be to that end. And, we've lived, like that's what guides our decision making, how we've done things. And just like you guys, a Reg A Plus isn't just come out of nowhere. It's like you do it because it meets the need of, that's what the business is about. is allowing people to have access to those sorts of opportunities, because that has been the issue, and it's improving daily now. The ability to gain access to alternative investments for non-accredited investors it's amazing. It's great. The democratization is taking place, and it's fun to see. For you guys in that fund, do the investors, is it like a debt instrument, or like they like borrowing money to the entity, or it's like buying equity, or what? Like, how is it structured in the Reg A Plus fund?
In the fund, in the Reg A Plus, it's structured just like our other fund. So they have equity ownership in the fund, and then we deploy that capital through two different strategies.
Yeah.
75% of the fund balance is held in loans we originate through Kogo Capital. So same model, making money off interest, origination points. And then the other 25% of the fund balance is held in the real estate assets that I mentioned, that our acquisition team goes out and identifies. And so they are paid earnings off of that. They get paid monthly earnings. They can roll their earnings, which is really neat. A lot of them like to just park it and set it and forget it, especially with IRAs. When you have small balance IRAs and monies are going back and forth, those fees get pretty expensive. So our funds give them the ability to just roll their earnings back into their equity, and a lot of people really like that. And both funds have a 12-month
It does. I mean,
tie-up
that's the beauty
period.
of it. I mean, like, that's the other thing, it's just
which goes by
liquidity, right? Like,
crazy fast.
The beauty of these debt instruments, or trust deeds, mortgages, loans, whatever you want to say, is the underlying asset is that, especially with the lower, 12-month average term or whatever, high velocity means you've got the ability to get out. Right. Unlike real estate, which is, less liquid, these things, as we've proven, this whole conversation has proven just how liquid that trust deed instrument is. I mean, you've got a lot you can do with it. You originate it, and you've got optionality now. Your ability to sell it to people. You can sell it to some people at a premium. You could take a servicing strip, keep that. It's a fascinating, sort of world. And I like how you guys have productized it. You've kind of taken and built the different components of it. And so, definitely, if you do have a low balance IRA, great, you should check that out. Great sort of, place to sort of park some of that money that just sits there, usually doing, because the whole thing with these IRA custodians, right? They're sitting on mountains of cash. That's undeployed. It's ridiculous. I mean, when the interest rates, right now they're not getting much on them, but I remember back in the day I was visiting, one of the larger ones, when, you could actually earn interest, like money market rates and stuff in the 2-3%. They were telling me it was staggering the amount of money they were making on interest. I'm like, oh my Lord, it's just unbelievable. So
I know. Well, and what I've found too lately with those custodians, a lot of them are much more open to not partnering, but promoting, right? Letting us, companies like ours, get on their webinars, their podcasts. I think COVID has changed everything, because everybody has podcasts, education, and it's really been nice to be able to help educate people. They have to be careful, the custodians, they're not giving financial advice, and neither are we. But at least just educate them about what they can do. Educate them about what a trust deed is, what a fund is. And so that's been, I'd say 90% of our database of our investors, people that are passively investing, use some kind of a self-directed account. That's how high that percentage is. So it's a great strategy.
Yeah, that's amazing. Yeah, most
I know,
definitely.
we could talk
good
forever.
Stuff, man. We could go on forever. So we overshot our time, but yeah. So look them up. You can find them on Verivest.com. As we said, they are a verified gold member. Happy to have them on board. And then where else can they learn more about you? What's the website?
Yeah. So. Yep, they can go to securedinvestmentcorp.com. So no S, just securedinvestmentcorp.com. We have a pretty great website where they can look at more information about the trust deeds or notes that we sell. We've also got information about both funds that we manage. And there's links. If you're looking to borrow money, you can find your link to Kogo Capital there. And then also on the education side, if people are interested in attending any of those classes, they can always go to the Lee Arnold System of Real Estate. So would love to talk with
Very
you more.
good. Thanks so much, Heather. Appreciate it.
Yeah, thanks, Lance.